Hi everybody, my name is Mary Redmond. I'm talking right now about the US dollar Canadian dollar pair, and this is a pair that's been in a long-term downward channel, and it appears to have made a break above and out of this long-term downward channel, and it has started to show the beginning of what could be a new upward channel, and it hasn't perhaps shown the momentum which would give a clear indication of a strong upward trend. But you do see this channel on a daily basis. You also see that it broke above the 100-day moving average. And the way it's been moving, it's making these little bull flags and then breaking out above them. So my guess is that we're probably going to make a breakout to the upside this week. And if it cleared the 98.50 level, I think it's possible that this pair could be on a move back up to the parity level. And it might not break out to the upside truly until the US Fed meeting next week, because the Fed is probably going to have to give a clear indication that they are going to cease the quantitative easing as planned, and that they're not going to be doing any additional easing measures for the time being. There's still a lot of uncertainty in that about the market, and it would be a big help to the US dollar if the US did pass the measure to increase the debt limit sooner rather than later. There's still a 70% probability that the US is going to be increasing the debt limit, but until it happens, it may be putting some pressure on the dollar. But the main theme in the market we saw over the last week is the beginning of a transition to a phase away from risk appetite, away from a bull stock market, away from a bull commodities run, and move towards what could be the beginning of risk aversion. And we saw that in the stock markets, and the Dow and the S&P both broke below their upward moving channels, their upward moving trend lines, which they've had for the last year, and they began to form downward moving channels. So this is significant because it shows that fund managers and money managers, along with economic managers and possibly company corporate managers, are really expressing through their actions some concerns about the second half of 2011, that it may be a lot more difficult to make money in the market than it was in the first half of the year, because we've had this cushion of $600 billion liquidity coming into the US markets, and we've also had extremely strong growth around the world in the so-called emerging markets of Brazil, India, and China. And we also had, for the last 6 months, we had an easing of the fears in Europe because of the establishment of the European Financial Stability Fund, and there really weren't as many concerns about the European debt problems. But just recently we've seen the bond yields spike up, and we're hearing a lot of publicity about the Greek sovereign debt problems. So that's coming into the spotlight again. And perhaps one of the most important factors for all of the commodity currencies, particularly the Asian currencies, but also US Canadian dollar, is how much the extent to which the rate hikes and the reserve requirement increases in China are going to be affecting the commodities growth rate. Most of the marginal demand in commodities comes from China, and they've been on a very aggressive tear of raising the reserve requirements. They did 8 times since October 2010, of a 50 basis points each time, which is really aggressive. So we may not have seen the impact of that yet, and of course there's some uncertainty. Nobody really knows, including the monetary officials, how this is going to affect the market going forward. Just as the US Fed isn't completely sure what's going to happen at the end of the quantitative easing. So there's a lot of major uncertainty in the markets going forward, and this should impact the commodity currencies in a negative way. And what we did see with the US dollar Canadian dollar, we did see a bullish cross on the ARSI, and we saw it move above its major moving averages. So far it hasn't cleared the 200-day moving average. But and there was some reaction to the Bank of Canada when they gave their policy statement on the 31st. I mean, Mr. Carney, at first it seemed like he might have been a little bit hawkish, because he did say that risks and inflation remain skewed to the upside, But in my opinion, they didn't really give a clear indication of whether or not they're going to raise rates in the next 6 to 12 months. I think a lot of it depends on what happens in other countries, which of course they can't predict. So we've also seen a pullback in oil prices, and we also saw that Saudi Arabia made a commitment to increase output, which may have had some impact. But really the marginal demand for oil, as well as the other commodities, comes primarily from Asia. So if we see a substantial slowdown in that region, it's going to affect the commodity prices as well as the stock market, as well as the commodity currencies. And the other commodity that I think it's important to keep an eye on is the copper prices. And since copper is really a true leading indicator of economic growth, if you see a substantial pullback in this particular commodity, which we have seen a slight pullback, but we haven't really seen a big downturn, it's going to be a pretty bearish signal for the global economy, and it's going to show that the rate hikes in China have had an impact, and the producers are starting to hedge more. So that's another thing to keep an eye on for the US dollar, Canadian dollar. But basically I like this on a pullback to possibly this, if it does pull back to this level of the support range of its upward channel, around 97.50, even 97.75. And if we are to see a break above 98.50, then I think it would be more of a confirmation that we're in a medium-term upward channel.